I was just referring to the VIX a short time ago with our guest. During this quarter, the VIX spiked up to above 50. Now it's kind of settled down to 17, 18. Are there any banks that are going to benefit specifically from some of that volatility earlier in the quarter, like we saw last quarter, where banks said they saw higher trading volume and they kind of benefited from the idea that investors weren't quite sure what to do?
Sure, and thanks again for having me. We've noticed, I'm looking forward to this earnings season with particular attention, as this last quarter earnings really encapsulated the way that banks can really capitalize on volatility, and they turned in really record profits across the board on several facets of their trading businesses. And now coming into this quarter, which had April, which we all know was a very volatile month, we're looking at these corporations as how are they able to wring out profits from a volatile quarter, and also looking forward to the rest of the year, as the yield curve has really extended itself to have a very profitable outlook on net interest margin for these corporations as well as how they can use their capital going forward. And so there are a lot of different tailwinds for the financials at a time when their valuation discount doesn't, in our opinion, doesn't truly reflect the capacity for earnings growth, earnings power over the next 2 or 3 years.
All right. I want to focus on something very quickly. When we're talking about consumer business, but all three of these banks, they have big consumer franchises. Which one do you expect to see the biggest deposit growth, which obviously gives them, the ability to have bigger net interest income?
Sure. JP Morgan and Bank of America are those names that we really focus on for that leverage from a consumer business. Bank of America is in geographically areas here in the U.S. that have shown above average growth from a demographic standpoint. JP Morgan really has the tools to really wring out profitability out of their consumer business as well. So we're looking at both of those to really lead the charge as far as being able to show the profitability, but also communicate to the marketplace just what position the consumer's in very early in the earnings season, when we feel like it matters a lot as to the growth of GDP and the expectations for macroeconomic growth, depending on how the consumer really continues to engage our economy.
Got it. By the way, just to get the audience on the same page, net interest income, that's the spread between deposits and loans. Very quickly, though, I want to focus on two things. We got to hit it really quick, Keith. You like the big banks better than the regional banks. Why is that? And you say deregulation is part of the story. What's deregulation going to help the big banks do?
A lot of the smaller banks just aren't regulated to the extent that larger banks are. They're not systemically important enough, deemed by the U.S. government. So we're looking at the big banks being able to utilize their capital in a more aggressive way as some of those regulatory standards move down. And also they've shown, as with the capital rules a couple of weeks ago, they've shown they've been able to extend themselves beyond what's expected of the federal government to be deemed safe for our particular environment right now. So we're looking for larger banks to really be able to unwind some of those restraints on their capital in a way that just haven't really held back the regional banks.
All right. I want to just focus on the regional banks since the last Fed meeting. If you look at the regional banks, they've outperformed the big banks, outperformed the market since the last Fed meeting when the Fed signaled 2 more rate cuts this year. Why doesn't that make the regional banks more attractive?
The regional banks are attractive, just not as attractive as some of the larger banks. They just don't have the levers to pull profitability-wise with the banking and trading businesses of the JP Morgan and Wells Fargo or Citigroup. So we're looking at the regional banks as potentially they could outperform the broader market, but just not the way we're looking at the world, the larger banks that we own in our portfolios. So the regional banks are attractive, in our opinion, just not as attractive as larger banks.